Hi, I'm Josh Mahony, Chief Market Analyst at Scope Markets. This Friday, the 2nd of August, sees the latest US jobs report, wrapping up a week that sees the likes of the FOMC, the Bank of Japan, the Bank of England, all reporting their latest monetary policy decisions alongside inflation data out of the Eurozone, and wrapping it up with the jobs report. But a lot of the volatility we've seen over the course of the week has laid at the foot of earnings season, as we saw a third of the S&P 500 report within the week. So massive volatility, and it ends with this jobs report. So let's take a look into it and see exactly what the trends are and see what kind of things we need to see for volatility to come into play around this event. So first and foremost, here's the market outlook. Expectations attached to this report: essentially a decline in payrolls down to 190, expected unemployment expected to remain flat, average hourly earnings expected to remain flat, participation expected to decline a tick. So by and large, it looks, according to this, like the action is likely to be on the payroll side of things. That is an interesting thing given some revisions we've seen recently. From a wider perspective, the reason why we, of course, care is the fact that we've got this downtrend in terms of inflation. We've got question marks from the Federal Reserve of when they're going to be cutting interest rates. And so it's a case of balancing inflation and the economy. And so inflation moving towards target, but certainly not at target. And therefore, the weaker the economy, the more we see signs of weakness from the economy, the more likely it is we're going to see a dovish Federal Reserve. Here's an overview of some of those key metrics as I just called out. You can see the big spikes or declines when it comes to the participation rate associated with the COVID pandemic. Many of these figures have come back down to pre-pandemic levels and normalized somewhat. So it's important to sort of zoom out and see exactly what is the norm and what is not the norm. You can see unemployment starting to move very gradually towards the upside over the course of the past 6 months. In terms of the breakdown for the non-farm payrolls, we can see here that the figure from a couple of months ago looks particularly weak now, and that came off the back of a downward revision. I'll show you it in the next slide, but certainly we've seen some significant downward revisions that all of a sudden start to make some of the previous figures look significantly less impressive, to say the least. So, it's an interesting one. They can come out with these huge numbers in terms of payrolls, and then, 3 months down the line, suddenly saying, oh, well, actually, we've just trimmed 100,000 off here and there. Markets, by and large, don't sort of take it in the same way that they did the first announcement in the first place. So, it's an interesting way that they do it over there. In terms of the breakdown over recent sort of gains in terms of jobs, there's been a heavy reliance on the government over the past month. You can see that significant move towards the upside in terms of that grey section. And it's notable that within last month and the month sort of 3 months ago, you can see we've got these two significant areas of downward growth. So roughly, you're talking about potentially 50% of the jobs being, created, also on the flip side, being taken away. So disparity coming into play. We're seeing some jitters within the sort of job creation that we weren't necessarily seeing the months prior to that. This highlights the size and the direction of the revisions that we've seen between the first and the third estimate of a non-farm payrolls release. So you can see that we have gone through some significant swings, but we're now in a position where the revisions have been overwhelmingly negative. So you see that first release, it comes out, everyone thinks, this is a great number. Let's say it's 250. And a couple of months down the line, suddenly someone says, actually, we've revised it. It was 200. So these revisions recently have been coming towards the downside. And to some extent, that means that the figures that we were looking at and saying, okay, the jobs market's looking very strong, all of a sudden it takes a little bit of a turn and they don't necessarily look as strong as they were previously. In terms of the sort of makeup of those jobs, payrolls have been particularly important, and the change between what's part-time or what's full-time is really key as well. We're sort of interchanging between it. You can see over the past couple of months, we've been gaining more on the part-time employment side of things and negative moves in terms of full-time employment. The more that we see that, the more you can discount some of the gains that we've seen from the non-farm payrolls figure, because ultimately, if you're seeing a bumper payrolls number and then you look into it and you see actually we're seeing downside moves in terms of full-time employment, and the gains that we're seeing are coming from part-time employment, that says a lot about the economy, and it's not necessarily as positive as that initial payrolls number might look like. So keep a close eye on the breakdown between part-time and full-time employment when you're looking at the payrolls number. Remember, we're expecting to see a decline this time around, back below that 200k mark. So if we see that, and we also see that essentially being made up of part-time employment, then once again, that's a sign of relative weakness that we could see the Federal Reserve look at with concern. In terms of the unemployment rate, I've reversed it here, so it's inverted, but we can see on that purple line that we've been gradually turning around, so increasing and pushing up through that 4% mark. We're now at 4.1%. I wouldn't necessarily say it's at a super concerning position at the moment, and it has been very, very gradual. But it'd be worthwhile noting if we saw a move towards the upside this time around. If we saw quickening in terms of the pace of unemployment, that's the kind of thing that we really could see markets paying attention to. In terms of the other two metrics that I've put on here, we've got the job openings figure, so the JOLTS job openings number that we did just see this week, and it actually came out better than expected. But nonetheless, the trend continues to be towards the downside for job openings. And the ratio between quits, so if you quit, then you feel more confident about your job, and people that are being laid off or discharged, that ratio has been moving towards the downside. So less people quitting, more people being laid off. And so, that again, you can see it sort of tallies up with the job openings, tallies up to an extent also with the unemployment rate. It's a sign of concern within the economy. If we were to see lots of people being laid off, not that many people quitting because they don't feel security within their job openings declining as well. So they're all sort of signs, tentative signs of weakness within the economy. Of course, the likes of unemployment, that's going to be a lot more important. That's going to be the headline number. If we see significant uptick in terms of unemployment, that's likely to see markets pointing towards a potential for increased easing from the Federal Reserve. The caveat being markets already pricing in 3 rate cuts this year. Another breakdown where we've also got that JOLTS job openings on a bottom section. I just wanted to highlight the sort of recent trend over the past few years for initial and continuing claims. We have been seeing them move towards the upside, but by and large, the initial claims figure, we're still at levels seen in early 2023, in early 2021. So we haven't really broken out towards the upside. We have been seeing gradual upside in terms of continuing claims, though. The JOLTS job openings number, like I said, is moving towards the downside. And, I should probably invert this conference board figure, but the ratio between those that find jobs hard to find and plentiful, or too plentiful, are pointing towards a move towards people finding it difficult to find a job. So we are seeing some underlying points of weakness within the US jobs market. In terms of the average hourly earnings, we can see on the top section, the light blue line has been decreasing. It's 3.86. You wouldn't necessarily say it has to get to 2% because that's not necessarily the target when it comes to average hourly earnings. But we can see the core CPI and average hourly earnings both moving towards the downside. Core CPI below the average hourly earnings, which means that real earnings are increasing, which is not necessarily a bad thing. You can see the 3-month annualized wage growth figure on the bottom shows that we've dropped back down into this sort of gray band that I've sort of clipped up the area that we were at prior to the pandemic, essentially. So pre-pandemic levels are highlighted within this gray band, and we've got back down into that over the last few months. So that is a good sign. We're seeing those underlying inflation pressures ease. In terms of market expectations for the Federal Reserve, the 31st of July, so this is when I'm recording it, markets expecting nothing in terms of rate cuts. Instead, we're expecting to see a rate cut in September. 87% expectation for a cut of 25 basis points and roughly 12 to 13% for a 50 basis point move. The back end of the year, we've got around about 65% chance that we would have seen 3 rate cuts this year. So unlikely that we're going to see a rate cut from the Federal Reserve this month, but markets are expecting to see a rate cut every month from here on in. And therefore, we need to see signs of disinflation. We need to see signs of potential weakness in terms of the jobs market to really hammer home that point. And therefore, that's why people are going to be looking at this jobs report with particular interest as we see whether the current expectation for 3 rate cuts this year are justified or not. Here's the view for the Dow Jones Industrial Average. We've been seeing it outperform the likes of the S&P 500 and the NASDAQ as we see some weakness within the tech sector. You can see from a wider perspective, we're tracking alongside this ascending trend line, creating this pattern of higher lows each time. You can see here the 76.4 fib here came just above that level here. We've pulled back into the deep fib zone between the 61.8 and the 76.4. So we're seeing some nice retracements. Some are short term, some are wider. We've seen this pullback coming into play recently, but the bulls are back in charge now. And the hourly time frame shows you that the pullback, lower highs, lower lows, the rally up through your swing high here points towards this period being over and likely the bulls being back in charge. So we have just seen a very shallow pullback and it's looking positive once again. But essentially for me, unless we break the 39807 mark, I think there's a good chance we're going to push onwards and upwards and try and push back towards this 41400 resistance level for the Dow Jones Industrial Average. In terms of the US dollar, well, a lot of it comes down to what's happening in terms of the US 10-year. And you can see exactly that here, right? It's very close relationship between the US 10-year and the US dollar. And what's happening? Well, the US 10-year is back below the lows that we have here. We have this lows in the middle of July, which is around about 412. Well, we're below that level. You look at what's happening in terms of the US dollar. That's not the case. And we can see here that points towards a possibility of a decline back through this low that we have here and a continuation of this bearish trend that's been playing out over recent months. Let me just get rid of the overlay and sort of highlight exactly how things are playing out over the near term. So let's go on to the 4-hour actually. So we've rallied up through this near-term resistance level, but we've been sort of struggling to maintain that recent trajectory. Towards the upside, the latest high is 104.8. But really the key thing here is, given the fact that we're falling back towards this area of support, are we going to turn upwards from here, or are we essentially about to roll over once again, as the 10-year might indicate? Look out for a breakthrough 104.138, 104.08. That area of support, if broken, could point towards that continuation towards the downside as we follow on what's happening in terms of the 10-year. So this is a really interesting area of support. If we were to see a particularly weak jobs report, then that would point towards further rate cuts and the possibility of further weakness for the US dollar. So whilst we see an inverse correlation between economic data and the likes of the Dow, we see a positive correlation between the US dollar and economic data, i.e. strong data should mean a strong dollar and weak data should mean a weak dollar. Of course, there's caveats to this because you also need to be able to look at the different currencies that you might want to trade it against. If you want to trade it against the Japanese yen or the Swiss franc, then you have some of the sort of risk attitudes built into that as well. But as things stand, the US dollar having pulled back and with the 10-year breaking lower, does have the possibility that we're going to see it roll over from here. But really, I think there's a lot to sink our teeth into. In the meanwhile, because we've got the FOMC, we've got more earnings coming out this week. And so the jobs report, depending on where we are at the time, perhaps we've seen a rebound because we've seen further selling in the tech sector. But certainly if we do break through this sort of 104.1 area, essentially, then it would point towards a possibility of us rolling over and continuing the bearish trend that has been playing out over recent months for the US dollar.